Thanks for staying on with us. Still tuned into First Trades, and the momentum very much going with the markets quoting at 11,353. The broader markets looking resilient, and you've got Tata Steel, ITC, JSW Steel and Hindalco as well as Z Entertainment leading the way. Clearly metals are in fine fettle. Well, let's get a roundup of what's going on when it comes to the earnings so far, how Q1 has shaped up, given that expectations were rife that it would be one of the worst quarters hit on account of the COVID pandemic. To talk about that as well as lots more, we've got Vinod Karki, he's the head of strategy at ICICI Securities. Vinod, great to have you on board. With the lockdown impact really impacting sectors as a whole, give us a sense as to which of the sectors you would have expected the economic activity to have contracted the maximum and how you've seen the results play out so far.
Hi, good morning. Thanks for having me on the show. So if you see, obviously the GDP is going to contract anywhere around 15% to 20% in Q1. That's the broader expectation. So in the light of that, everyone would have expected that this would have been a quarter of large misses on whatever expectation we had put out. But if you remember, some time ago, we had analyzed how the forecasted numbers are moving. And we had noted that during the COVID, since March, in fact, we have had the largest downgrade cycle so far after the global financial crisis. So FY21 earnings were cut almost by 30% over this period. And because of that, we had we had noted that going forward, the estimation error would be lower because, the expectations are pretty low. Now, this phenomena has started showing up in numbers, it seems, at least so far, where the expectations are pretty low now. And whatever numbers we are getting are broadly beating estimates or are in the neutral zone with very few misses. Having said that, one is expectation versus what actually comes out. But even in terms of growth, if you see, while the GDP is going to contract by around 15% at least, I think the sales growth is also kind of in that number. But the operating profit so far, if I just look at the Nifty 50 free float numbers, including the banks, the operating profit is largely flat. And whatever we are hearing from individual companies seem to suggest that there has been a lot of, what you should beat on the operating margin side, largely driven by, we have seen cost-cutting measures across companies and pretty healthy margins across. And input costs has been also pretty okay. They haven't risen that fast, except for one or two things. Which is basically cement was a little higher, but otherwise the input costs have not been a problem. So on the profit side, on the PAT side, things obviously are not that, obviously there was no growth, but as I said, they are well above expectation. So net, it's a case of a slow recovery in the economy. We saw some momentum being lost in July. If you look at the PMI number, it kind of dipped a bit. And we saw GST collections also dip a bit. Largely, if you look at the Google mobility data, largely we saw some momentum being lost in July. I think the reason is, one, that monsoon really picked up in July, and also, and COVID also was expanding across the country. So all in all, a slow recovery. However,
right, Vinod, I wanted to get in your take on the financial sector, if I may. Vinod, just wanted to get in your take on the financial sector. In the report, it's mentioned it's a case of Schrodinger's cat paradox. Can you elaborate on that?
So that there's a thought experiment in quantum physics where unless you open the box, you don't know whether the cat is dead or alive. So that's the case. I think for financials, when I say that, it means that unless we end the moratorium period, we won't actually know how much of damage was done, which banks really took proper provisioning and covered their losses. So all that will come to, we will get to know a better picture only when the event is past us. But whatever body language from large banks and their commentary seem to suggest that things are not as bad as originally thought to be. So that gives a confidence. However, as I said, only time will tell whether the estimation that in banks and because if you see the RBI's latest report, it does suggest that the NPAs are going to rise from 8.5% to 12.5% next year. However, from the commentary from banks, I don't see that kind of warning coming in so far. So that's why I say that it's still uncertain over there. But at least some of the better banks, I think, will tide through this crisis better than the rest of the pack. Yeah.
Okay. We were talking a lot about some of the pharma names. Vinod, if I were to kind of pick certain sectors in particular, have you been positively surprised by some of the earnings that we've seen there?
So definitely, it's been a positive surprise. Broadly, if you see the economy, I was just doing analysis as to which parts of the economy, domestic economy, obviously, have held through this crisis. So one is the essentials. So if you look at the unorganized segment, also the mom and pop stores, who are selling essentials, which includes food and medicine, they have done pretty well, apparently, as compared to the organized retail. I mean, it was spoken about by the largest organized retailer like DMart and all. So if you see, most of these pharma companies, their domestic business, they have really boosted the performance. And I see that globally also the regulatory overhang that we used to have a significant amount of, observations and all, I think that is reducing. So I think it might be a situation where the environment for pharma is on the mend after several years of challenging environment. So let's see. But yes, it's a surprise for sure. And that's how the stocks are reacting. They are at the upper end of the valuation range historical that we have seen so far. So that's being reflected in stock prices. Yes.
So that's on pharma. What about cement as well? We were just speaking with Shree Cement and a couple of the other majors as well. In terms of outlook, have been sounding a lot more positive. What's been your takeaway there?
Space, because see, if you read through some of the management commentaries up to what happened in Q1, so because see, cement is largely you can directly correlate it with the gross fixed capital formation, how much of capex is happening in the economy. So if you know that the private capex cycle is in a slump, government spending, I don't think Q1 would have picked up significantly, except for, I think, releasing of payments, where I think there have been some information that, as they are front-loading the borrowing program, the payments are getting released. But the one interesting point I got from some of the cement players was that the individual home building in rural India, especially after migrant workers left the cities and went to their home and they needed additional space, that's driven a large amount of the cement demand during Q1. So it's getting well balanced, where the agri-rural sector, individual home building and all in the rural space is holding on demand to some extent in this challenging period. Whereas once we see the urban areas also pick up and the government spending also pick up from here on, that could balance the rest of the portfolio. So it is well placed in my view, broadly, if you were to see from a demand perspective. And the pricing has been pretty well, that's noticed by everyone that the pricing has been buoyant. That's not an issue. So we remain positive on this space. Actually, one of our best picks is from this space, Ultratech.
Thanks, Vinod, for giving us a roundup of how the earnings have shaped up so far and what you've made of individual sector growth.